appropriate that, maybe not, okay? But at any rate, that percentage comes from them, right? Calculate the minimum premium. Okay, the minimum premium is going to be just a math exercise. We're going to take the standard premium times the minimum factor. Minimum factor also comes from the underwriter. All right. So, oh, and I skipped one, I'm sorry. Okay, which is the middle part of the formula. So on number 3, we're going to calculate the indicated retrospective premium. Now this, okay, equals, and this is the key formula, okay, and it's universal, all right? No matter what insurance company it is, the formula is the same. It's going to be basic premium plus the losses, okay? Now, the losses at that point could either be incurred loss or paid loss, one or the other, depending on the plan you have, okay? Times the LCF, okay, loss conversion factor, and again, that comes from the underwriter, times the tax multiplier, that comes from the underwriter, plus the non-subject premium, and that comes from the underwriter, right? So some of this is filling in the, the factors. However, this is the $1 million piece, okay? Good losses, low premium. Bad losses, high premium, okay? Tax multiplier, this is an estimate, okay? The insurance company is going to give you a factor. They're going to multiply it by payrolls, okay? So, subject payrolls, and that's going to generate a number. You're going to pay that, and then when the actual premium audit is done, the taxes go from an estimate, which is this factor here, all right, goes from an estimate to an actual. So for example, if you have 10 million of payroll in Indiana, the amount of tax for Indiana would have been contemplated here, right? And which would reflect all states. But then when the premium audit's done, they're going to carve out of this little bundle, okay, the exact dollar amount that goes to Indiana based upon that payroll, which is a function of the audit. Okay? And then we're going to calculate the maximum premium. Okay, and this you also you want to pay attention to. Maximum premium equals the standard premium, okay, which you have over here, times the max factor. And the factor, anything that says factor, comes from the underwriter, right? Here is the way it's laid out, right? Indicated retro premium equals. Now, when they say indicated, okay, all of this is estimated, okay? They're estimating what the premium for a given year is going to be. And the reason why they have to estimate it is because we don't know what the final losses will be. If all of our losses happened in one year and closed within that year, okay, life is a lot easier, okay? Because you would do this calculation once at the end of the term, you would do the premium audit and this calculation at the same time, done and over with. Fact of the matter is, losses, okay, will, for multiple years, will keep causing this calculation to repeat itself year after year after year. So I've actually had retro calculations for 25 years, policies that we had 25 years ago, and they're still going through this calculation because there are losses or one loss that remains open. And these do not close until the losses are closed. Now, on a program agreement, the savvy broker will say, okay, let's build into the program agreement a closure mechanism. So for example, if outstanding losses, incurred losses, okay, are $1,000 or less, the insured can pay the amount of the remaining incurred loss, the reserve, and close the formula. Right? Reasonable approach. And I will share with you back before, electronic transfers were so commonplace, okay? I had one claim open on a retro from about 20 years prior, long before my time. And for probably 8 years or 10 years, okay, I would get this stack of calculations, okay? And I would owe the insurance carrier $600, okay? The next year they owed me 700. The next year I owed them 800. The next year they owed me 400. And this went on for like 8 years. And it was $35 in FedEx to send me the paperwork, okay? You know, so again, kind of nonsense, all right? So you got to, again, from an astute perspective, you want to build in a closure plan, right? So, all right. So let's take our break here, all right? And we shall jump into these calculations a little further on. Okay, can you guys see me and hear me? Good. Again, I gotta tell you, that's really refreshing. So, okay, um, so just to warn you, okay, this part is a little dry, a little boring. I will do my best to make it interesting and entertaining, especially since this is kind of the end of the day. Um, so thank goodness for polls. Otherwise, I think if I were in your shoes, I myself would be falling sound asleep. Okay. However, recognize on this, okay, you can stand out as a superstar by understanding those portions of insurance that nobody else wishes to understand. Okay. And I really mean that. So let's talk about how do we do this, right? How does it all work? So a typical circumstance will be um, the basic premium. Okay, so here's our problem. Basic premium is 50,000. How did we get the 50,000? Well, we got the 50,000 by taking the standard premium. All right, you remember on the uh, standard premium equals manual rate times actual experience modifiers and charges and projected exposure units. Right, so that's how we got the standard premium. Wait a minute, why isn't this? Okay, that's how we got the standard premium, or excuse me, the basic, and then the 20%. Okay, this number here, remember, this comes from the underwriter. All right, so don't sweat that. All right, all you need to know, okay, oops, darn it, keep going the wrong way, is this table. Okay, how do you come up with these numbers? Remember, the factors come from the insurance company. So we're going to set this number aside. We're going to use this. Okay, here's our loss pick, okay, which in this case 200,000. Now, recognizing all of this formula builds upon exposures and loss picks. So now, do you understand? And hopefully the answer is yes. Why the loss pick is so critical? If the loss pick from one insurance company is 100,000 and the loss pick from another insurance company is 300,000, who's going to have the better number? Now, come on. I'm going to be asking a bunch of questions here because, again, this is the tough part. Yeah, Kendall, you got it, 100,000. Okay. And why? Because they're understating the actual loss pick. All right. So that's why there's a lot of how should I say it, opportunity to manipulate the numbers. And so on a retro plan, most buyers have to be a little sophisticated to figure out how all of this works. And they do so, hopefully, with the counsel, okay, of their agent or broker. So remember, the loss pick of 200,000 is probably, and for the sake of this example, let's say it is the correct loss pick. Okay. Well, if you go in with a loss pick of 100,000, you end up at 200,000, well, then you're going to owe some money. So in a sense, understating the losses is kind of like a depressed retro plan, right? Because you're understating the actual exposure, right? So, recognize that. If the insured wishes to do that, boy, do you want to document your file? Okay. I can't emphasize that enough. The LCF, loss conversion factor, here, this comes from the underwriter as well. Okay. And that's saying that whatever the losses are, 10% of that is going to be the loss conversion factor or the claims handling fee. In this case, 20,000. The tax multiplier, that comes from the insurance company. And in looking at this, I would never argue the tax multiplier because that's just an estimate. And all underwriters, they are not going to get into doing the calculation, especially with 10, 20, 30 states, doing this number right down to the last dollar. They're going to do it once when the premium audit is done. Okay, that's one. And then as the claims actually materialize, because claims are taxed, right? So, again, I would never argue this, okay, because at the end of the day, it's an estimate and it gets replaced with the actual. So now, how do we actually determine what our retro premium is? Well, okay, or in other words, what the quote is that we're going to get from the underwriter. Well, the basic premium, okay, the 2.0, that comes from the underwriter, times the standard premium gives us the 50,000. So the 50,000 comes down here to the formula, right? So that's our basic, right? That's not the minimum, it's the basic. Plus the losses times the loss, handling fee of 10% times the tax, okay, equals what our estimated premium is going to be. So let's talk about where the variables happen. Well, here's the first one, the 50,000 is based upon a standard premium of 250,000. Well, if your payrolls change, then the standard premium is going to change. This is going to remain constant. So if the standard premium goes to 300,000, that's going to affect this. Instead of this being 50,000, it's going to be 60,000. So that comes down here. That's going to be in year one adjustment. Year two, all right, and that will remain constant. Right? Year two, our losses, all right, well, if the estimated loss pick is right on the money, terrific, never going to happen. The estimated losses are going to be replaced with the actual losses that are known at the time. The things that are going to impact the estimated losses are going to be IBNR, incurred but not reported, okay, and the actual losses, what they turned out to be. So here's our pick of 200,000, and maybe for the first adjustment, the 200,000 is, 300,000. So you're going to owe more money. Maybe it's a 150, and you're going to get money back subject to the minimum. Okay, you're never going to be charged anything less than the minimum. Right? How are we doing on that so far? All right, we okay? So let me see here. So Rachel, you were saying, you made a comment here, lower loss pick. What was that in? Oh, never mind. Okay, that was in reference to who's going to pay more, the higher or the lower loss pick. And yes, you're right, the lower loss pick will pay less, right? But remember, it's eventually going to turn into what the actual is. So the lower loss pick or the higher loss pick will really just affect cash flow, but not the ultimate liability. Remember what we said, and this is a key thing to remember, under an incurred loss retro or a paid loss retro, when all of the claims settle and they're all closed, the two methods should end up to be the same cost. All right. A lot of people don't understand that, but within a few bucks, one way or the other, from a textbook perspective, they will be identical. The difference is the cash flow along the way. Okay, so after the policy term, the standard premium is subject to audit on actual exposure units at the end of the policy period. Again, no surprise here. All premiums are recalculated based on the audited standard premium. All right, now we covered that here. The basic premium, okay, is a determination based on the standard premium. Standard premium is going to change based upon, as an example, sales changes, payroll changes, whatever, whatever the basis is. And it's an estimate. Sometimes people will quote these things and say your annual premium is going to be 278,000. Well, no, okay. Although it's possible, it's highly improbable, right? You have to, in order to do that, of making this a firm quote, your losses have to be exactly 200,000, right? The tax multiplier, okay, ironically, has to be the correct percentage based on the actuals for each state, right? And okay, the standard premium had to have been 250,000, which means your payrolls had to have been the same, exactly what was predicted. Never gonna happen, okay? This is only an indication. There are typically a series of premium adjustments. An audit return premium 6 months after the expiration, also referred to, so you know, also referred to as 18 months after policy inception. So insurance carriers rephrase it either of two ways. You end up at the same place. Now, a lot of times, okay, the smaller, more regional insurers, okay, don't always get to these calculations, okay, and sometimes, it can be a year because nobody wants to actually do it. So, as an agent or a broker, what I think I would do is I would do these calculations. And if it's to the favor of the insured, sit down with them and say, hey, here you go. This is what the bill should be. They haven't done it yet. Set the money aside, okay? Because someday it's going to materialize. And on the other hand, if the insured is due money, okay, you sit down with the insured and say, hey, they aren't doing the calculation. You're due for this 18 months after policy inception or 6 months after expiration, whichever, whatever, however they phrase it, okay? I'm going to start banging on the door to get this done and get you your money back. Either way, you're a hero, okay? The mere fact that you took the initiative to establish this and communicate with the insured, you're watching their money and you understand the plan that you sold them. Okay, so big deal on that. All right. Let's see, when they say, and I'm right here, okay, the first retro adjustment, then altering additional and return premiums for subsequent years for as long as the claims remain open. So these calculations are a little involved. A lot of it's pretty automated, all right? But if I have a claim and the reserve is $10, if I don't modify my program agreement, these calculations are done year after year after year after year for a claim that has, a $10 reserve. Now, granted, a little bit absurd, but I've seen these things go on for years for, a $3,000 reserve or a $4,000 reserve. And then, a new broker gets on it and says, hey, why is this still open? They dig into the claims file and they find out that it went to pension, okay, which is always a big concern, right? When it goes to pension with the insurance department, maybe it closed while it was in pension, but nobody notified the retro people to say, hey, the claim's closed. Okay, so this stuff happens, more common than not. Right? Now, question becomes, how do you verify a retro adjustment? Right? Now, you can sit down, you can do this longhand with all the math, right? Or the shortcut, okay, and this works every single time. The shortcut is verify just the factors. Here are the key pieces, all right? So for the basic, 0.2. Yep, okay, done. That was the 0.2 was quoted. The 0.2 was used on the calculation for the adjustment, okay? So that's a check. LCF, 1.1. Yep, that was on the quote. That's what's on the adjustment, check. Tax multiplier, 1.03, that was on the quote. That's what's being used on the adjustment, check. We're good to go on that. Okay? And the next is the losses. Okay? Did they use the most current loss run? Once you verify those things, and those are all pretty simple, it takes you 5 minutes. Okay, it'll take you longer getting all the data together, getting the various pieces, pulling out the quote from the file or electronic file, whatever it is. Okay, but once you verify those pieces, you're done. It's over. Okay, multiply it out, plug the numbers into the equation here. That takes you 5 minutes. All right, and then you can determine. Okay, if this number comes out to be, 210,000, then the insured is entitled to 68,000 back. Right, and guess what? You tell the insured, and you jump on the phone and you start hammering the underwriter saying, where the heck's my money? Right? And on the other hand, if you do this math, and again, 5 minutes, that's all it takes, or less. Right? If this number comes out to 375 or 550, you sit down with the insured and you show them the math and you show them what it is expected to be, and tell the insured, look, set the money aside. Okay. Someday the insurer is going to catch on. They're going to send you an invoice. Okay, you got to be ready for it. And they're going to say, "Whoa, thanks, appreciate it." Okay, now on some of these, these plans, again, an astute broker will build this into the program agreement to simply say, "Hey, look, this is a paid loss retro." Fine, no problem. Again, that's preferred. However, if you have claims that are open for years, most people are going to want to be able to close out the paperwork and be done with it. Get rid of this stuff. So there's a conversion provision that allows the insured, excuse me, to convert from a paid loss ratio to an incurred loss ratio, pay the difference, be done with it, closes out the retro. And that's actually, if I see that in a program agreement, I think to myself, wow, somebody was on the ball. A good friend of mine, worked as a risk manager for a large national automobile leasing, not leasing company, moving and storage company, truck lease, and that kind of stuff. Big outfit, everybody'd recognize the name, is named after a race car driver, And so this guy, again, good friend of mine, George, he started his role there, and there was a provision in the policy, in the program agreement, that said this is a paid loss retro. However, after 5 years, this converts from a paid loss retro to an incurred loss retro, and the insured needs to pay up, if you will, pay to convert to an incurred loss. Well, so this went on for a few years, several years before my friend George got there, and the insurance company wasn't following up with the insured. It kind of got kicked around the office. Nobody really understood the program. Nobody really wanted to undertake it. So my buddy is reading the program agreement, much to his credit, and he goes, "Oh my gosh, this has a conversion process in it, and it's mandatory. It wasn't an option." So to try and make a long story short, when the 5th year came up, he had to come up with $7.5 million. Write a check or do a wire, whatever the mechanism is. Bing, here you go. So he did the math. And he was in the ballpark. Sits down with his employer and he says, "Hey, did you know?" And everybody goes, "No, they have no idea." And if they did, they had no idea what it meant. So the insurance company, when they realized that they had a new risk manager and he has a bit of a reputation, of knowing what he's doing, they decided, time to revisit this. So they go out and they visit my friend George, and they said, "Hey, George, did you see any of the program agreements? And he was like, well, yeah, probably. Why? What's up? And that's when they talked about the difference between the paid loss retro and the incurred loss retro. And after 5 years, it's a mandatory reversion process that converts the paid loss to the incurred loss. And then they said, and by the way, here's your invoice for $7.5 million. Okay, you got 30 days. Okay. And so he's a little bit similar to me, and he had a comment to make regarding that. Okay. To make a long story short, they put him on a 3-year payment plan, okay, rather than 30 days, right? So, again, you got to understand these things, because if you don't, the financial impact can be catastrophic, right? So, and expose your E&O coverage, right? So just FYI. Okay, so the last piece here, okay, a return premium is paid to the insured, okay, if losses are less than projected. An additional premium is paid to the insurance carrier if losses are greater than projected. Now, I'm just going to insert 2 pieces here. Okay, a return premium is paid to the insured if losses are less than projected, but above the minimum. Because remember, on these plans, you got a minimum and a maximum. All right. So just because the losses are lower, and let's just for the sake of argument say the losses are 0, you're not going to pay 0 premium. You're going to pay the minimum. And if the losses are greater than what's projected, you're going to pay those, but again, subject to the maximum. So if your losses are phenomenally higher than anybody ever expected, you're probably going to be subject to the maximum under the plan, because again, insurance carriers aren't in the business. Okay, some people might disagree, okay, to put companies out of business, okay, to get their premium. Right? So just FYI on that one. How are we doing on that? That's a lot of esoteric, deep, insurance mumbo jumbo, but it's pretty important stuff if you are going to be talking about retros and to sell them. Okay, so a great plan, I mean, really great plan for the right company, but this is one of those things, a lot of agents and brokers, they sell a retro plan that looks great and they have no idea what they sold. They have no idea how it works. They have no idea how to verify it. They just kind of keep their fingers crossed and say, I hope there's not a problem. Okay. There is. I can't emphasize that enough. So be cautious on that. And for people that really understand these things, okay, there are rewards for that. Okay, so financial dynamics of retro plans. There is no specific retrospectively rated insurance policy. Okay? And yeah, that's exactly it. The insurance policy terms and conditions, the coverage terms and conditions, okay, are the same. What we're talking about here when we're looking at these formulas, all right, what we're talking about here is the premium calculation. It's really no different than a deductible obligation if you have a large deductible plan. All right. So again, the coverage is the same. The policies are the same. So don't get those confused. What we're talking about here is a payment plan. That's what's different. How is the premium determined? Not how the coverage is determined. Those are 2 separate things. Let's see. The underlying insurance policy functions as a guaranteed cost policy with one notable addition, the retrospective premium plan endorsement. That spells out how the premium is calculated. Right? So we okay with that? So far, so good? Okay. So either you're falling asleep or you're ready to shoot me, one or the other. Excuse me. Now, sorry, internal funding and risk management. Now, as a risk manager, do you think that I'm probably a little bit more aware and supervisory in nature following a retro plan than I am about other things? The answer is yeah, okay? Because if it works, I'm a hero. If it doesn't work, okay, I'm probably going to be put on a performance plan, okay? Or maybe not, because nobody else in the company would understand what these are, how they work, all right? So maybe there's a provision of this that's a little bit of job security, I don't know, all right? But the amount of internal funding can vary greatly in retrospective rating plans, and both parties, okay, affect the amount, okay? So again, okay, if you're on a retro plan, okay, and you have a high max, okay, a high maximum, then you're probably going to have a lower minimum, which is good. All right. So the insurance company is saying, insured, if you're willing to take on additional risk for high losses, thereby protecting the insurance company, we in turn will give you a lower minimum, okay? Because if you do well, we don't have a problem in giving you money back. Now, I know that's hard to imagine coming from an insurance company, but that's the philosophy, okay? Um, okay, is there a cap on individual losses on a retro plan? I don't think so, but want to confirm, okay? No, okay. Well, it depends on what you purchase, all right? So let's go back to the formula, May, all right? So let's see. Estimated losses of 200,000. This number represents, okay, your losses that you're exposed for, okay? So that's part of the negotiation process. What are my losses going to be such that, that's my exposure, that's my loss pick, okay? So the estimated loss is also known as the loss pick, okay? And the loss pick is based upon what the insurance company expects you to be subject to. All right. So good question. Okay, we covered that. Okay. So internal funding, the insured must select an amount that meets the risk appetite and the risk-taking ability. Okay? The insurance carrier will require amounts according to the maximum and the minimum premiums and per occurrence loss limits within its comfort zone, representing its own risk-taking appetite and ability. So this is just, an acknowledgement that insurance carriers, okay, through the assignment of a minimum and a maximum, okay, do so based upon what their risk appetite is. So and that's quite normal. I can't emphasize enough on this provision that what you are looking at from an insured's perspective is enormous premium swings based upon losses. So remember, they're not, as an insured, you're not only going to pay for the losses that you incur and the changes in the loss development. If a loss increase, you're going to pay that. All right. So then what's going to happen, okay, is the premium is also going to change based upon that loss pick, or not the loss pick, excuse me, on the actual loss. Right. So again, those swings can be huge. And if you are a sophisticated buyer and have a good risk management plan to manage those losses, like I said, you can clean up on these things. Okay. They really can be a great, great savior. Right? Loss sensitivity and cash flow. With retrospectively rated plans, the degree of loss sensitivity can vary significantly. A higher maximum premium leads to greater loss sensitivity, while the absence of a per occurrence limit further increases it. Okay? Conversely, If there is a low per occurrence loss limit or a narrow range between minimum and maximum, the loss sensitivity diminishes, right? Does that make sense to everybody? So the greater the risk to the insured, okay, in terms of losses, okay, is going to be an overall increase in financial risk to the insured because of the changes in the premium, okay? And then of course the obvious, which is you're going to pay for your losses. However, if we take some of that variability out of it, the minimum is higher and the maximum is lower. In other words, the part in the middle that the insured is responsible for narrows, okay? Well, then the factors, okay, it's going to be a more expensive plan, okay? So, it's risk versus cost. So, tax treatment. Now, by and large, I really don't get involved with our program tax-wise. I've got to provide some information to our Treasury Department and our tax department, that kind of stuff, all right? But on the actual retro program, the tax multiplier, that's really an automated process that comes from the insurer. They take care of all of that stuff. The one thing that, from a tax perspective on this, is that 1.03, all right, that we had. Whoops. Where was it? This 1.03, this is merely a factor to verify. Okay, that's it. Okay, is it on the quote? Is it in the math formula when they calculate the final number? And if the answer to that is yes on both, it's a match. Fine, done. Don't go any further than that. It's a process of diminishing returns, because if the insurer messes up and pays the wrong taxes, okay, well, guess what? It's the insurer's problem. You're free and clear. Who cares? All right. I mean, that's kind of my feeling. Okay. So, um, oh, okay. So that's not me. Bing. Yes. Okay. Tax treatment. Sorry. Premiums that are paid and unrecoverable are deductible. Okay. Um, when an obligation arises under cash or accrual accounting, okay. However, the deductible of losses poses a challenge for tax advisors and risk managers. Okay. The deductibility of losses, not so much, because when you pay these numbers, okay, the invoices, that's an insurance expense. That's deductible. All right. So, on this, the deductibility of losses, incurred losses, I would agree with. Okay, that's a challenge. However, you know, once you pay the invoice, that's all going to be tax deductible. Generally, losses are only deductible for the insured when they are paid. Okay, so under a paid loss retro, not a problem because it's all based on paid. Now, this I think is true if you're on an incurred loss retro. Okay, so I'd even make the argument that that still becomes a premium charge. Right, but not for me to solve. Right, but that would be, I think it's more convoluted if you're under an incurred loss rather than a paid loss. Paid loss is pretty straightforward, at least from my perspective. We want to talk about the pros and cons really comfortably, okay, on a retro plan. So some of the advantages, um, most effective portion of risk financing, yeah, one, I control my program, okay. My premium is tied to my losses, as frankly, I think it should be. That makes sense to me, all right. If I do well, I'm going to save a bundle, okay. Now, keep in mind, when I say save a bundle, I'm talking hundreds of thousands of dollars, depending upon the plan, okay. So that's positive. However, okay, I got to be pretty confident about my structure of the program to be sure, frankly, everybody that has a say in the losses, they've got loss control religion. You know, they get it. Okay. I can't be having a conversation with somebody who says, you know, these loss control engineers that come in are a pain. You know, we don't want to deal with them. Okay. I'll never forget this story way back when. Okay. Um, I used to do auditing, and I was this company that was a logging business. So they would go into the woods, cut down these big giant trees, drag them out, put them onto a flatbed truck or a helicopter, and then bring them to a sawmill and make lumber. Okay. And so usually the number one cause of death in that industry isn't from the actual injury itself. It's because they bleed to death before they get to medical care. Because some of these logging operations are, you know, maybe 10, 15 miles from a paved road, but the road, that 15 miles, is full of potholes, you know, and the speed limit's, you know, 10 or 15 miles an hour if you're in a car, all right? Because they're used to big, giant trucks. And so I remember having a conversation with the guy, and he, you know, the subject got to insurance for whatever reason, and he was complaining about all these insurance companies, you know, how they charge him for, you know, a ton of money for something that, you know, they make a fortune off of, and, you know, off mainly off the backs of laborers and business owners, you know, in the logging industry. Okay? And I'm thinking to myself, yeah, okay, maybe not, you know, another issue. But as I'm talking to this guy, okay, he's got one arm. Okay. So I'm thinking to myself, you know, anyways, in the course of the conversation, he brings himself in as an example. Take me, for instance, okay? And the loss of, I'm sorry, I don't mean to be laughing at the circumstance, but he lost his arm in a work-related injury. And thankfully, he didn't bleed to death, all right? So, and actually, a lot of these logging companies, they get together and they have signed up and share a helicopter service. So if any particular company has somebody with a serious injury, they get on the phone, they get a helicopter, comes in, put him on a stretcher, out he goes, and he's at a hospital in 15 minutes, as opposed to hour and a half to get to a paved road. All right. So at any rate, this guy was arguing that, you know, insurance companies, you know, make much more out of the deal than it should be, and everybody overinflates their claim. And he gets into, now take me, for instance, okay, I lost my arm on, you know, piece of equipment of some sort. And, you know, 6 months later, okay, I'm back at work and I'm using the other arm, you know, and I'm sitting there going, well, you know, okay, maybe not everybody feels that way, but, you know, so be it. But I'll never forget that guy, you know, and those things, you know, happen. And, you know, that would be a major hit for him if he was on a retro plan. Okay, major hit. Okay, they're widely available and offered by many carriers. Now, interestingly enough, I learned actually in doing one of these programs, many states, we all know about an assigned risk plan, right, for workers' comp. Many states, okay, many states, and I think all of NCCI states, okay, an assigned risk will offer, if asked for or if demanded by the insurer, okay, a retro plan. I almost fell off my chair when I learned that. Okay. And namely, it's intended to be a benefit for insurers when they get stuck with an assigned risk with large catastrophic possibilities, you know, for injury, okay, and an insured that frankly they could care less. Okay, it doesn't matter. You know, stick it to the insurance company. We don't care. Okay, if our mod ends up going to 3.0, we'll just reorganize under a new name. my son or daughter will be the new president, and we go back to 1.0. Okay, so a retro plan is a way that potentially forces the loss control religion on a business owner or a business that you know doesn't really care about their loss results. So disadvantages. Okay, if loss experience worsens during the retrospective rating period, a retro plan can become the most costly option. Okay, so when we talked about the standard premium, a maximum, okay, might be, okay, 3 times the standard premium. Okay, so the max, these can be big numbers. Okay, I can't emphasize that enough. Okay, so a high degree of loss sensitivity within a retro plan can cause fluctuations and instability in the total cost of risk. Yeah, so one year you might get 200,000 back, and the next year owe $1.5 million. Okay, until all the claims are settled. So yeah, these things can be all over the place. So you really only want to be talking to people about a retro plan when, one, they're okay with the risk, but most importantly, they understand the risk. Okay. Now, I would even plug in, okay, when you get the quote from the underwriter based on the loss pick, I would automatically include, okay, a deviation from that. If you have a loss pick of half of what the estimate is, this would be your indicated premium. If you have a loss pick that's the actual loss of 2 or 3 times the loss pick, this would be your indicated premium. Something to illustrate to the insured, it's not going to be $1,000 more. Okay, it's going to be a lot more. All right, so that would be my thought on that. Let's see. Now, I've not often, but have had meetings, okay, to explain large retro adjustments. Okay, and thankfully, I was lucky enough to understand it and be able to have an intelligent conversation and explain it. Okay, so you might be in that situation, and boy, you better understand these things. Right? And it's a good thing to know. Right? Multiple adjustments over several years until all claims are closed. I can't emphasize that either. Sometimes I've seen agents and brokers say the indicated premium is the premium for that year. Okay, it's like, well, no. Okay, that's only year one of that year. Until the claims are closed, that will keep adjusting up and down and up and down and up and down for 2 years or 20 years. Okay, until the last claim is closed, unless, of course, you built in a closure process in the program agreement. Okay, again, that would be an agent or a broker that is on top of it, understands it, okay, and carries it the next step and say, okay, it's easy to get in. How do we get out? Okay, so let's talk about our knowledge check. Smithville Widget Company has been diligently benchmarking its production, sales, and losses over the past few years to improve quality and reduce losses. Thanks to the efforts of their risk manager, hey, there's a plug, okay, they have seen significant improvements in operational efficiency and cost control. Okay. Now, as they prepare to renew their workers' compensation insurance, the company is presented with an option of a retrospectively rated plan. Now, before we get on to the question, let's look at key pieces of the information that we are given. Diligently benchmarking. Not all companies do that. If somebody is benchmarking, I'm saying to myself, oh, okay, well, you're certainly a little better than average, all right, in sophistication and in knowledge. So that's a plus. And they're benchmarking production, sales, and losses. Now, the fact that they're benchmarking losses tells me, oh, okay, Well, that's really pretty intriguing. And yeah, they're clearly on the sophisticated side. They've been doing it for a few years, okay, to improve quality, okay, and that's the manufacturing side. So while that might be interesting, that doesn't really pertain to me per se. And reduce losses. Yeah, okay, good. Thanks to the efforts of their risk manager, they have seen significant improvements in operational efficiency and, again, don't really care about this, and cost control. Okay. Now, as they prepare to renew their workers' comp, okay, they're contemplating or being presented a retro plan. Okay, so at least initially, I'm thinking this might be a good match. Okay, a complex plan that greatly rewards somebody, okay, who understands the importance of cost control. All right, so at least conceptually, I'm on board. This is probably a good match. How could Smithville Widget Company focus on benchmarking and reducing losses impact their decision to adopt a retrospectively rated plan? Okay, what are the potential benefits of this approach? Okay, so, well, immediately things that come to my mind on this, all right, is what I would benchmark is the factors in a retro plan, okay, namely loss pick. Okay. LCF isn't going to vary too much. Okay. But I would look to also benchmark the minimum and the maximum. Okay. And the basic, those factors. And that's an easy comparable number to other companies. Quick, it's easy, takes 2 seconds. Okay. So that would be something that I would look at. I would look at loss trends. Okay, assuming that the exposure has been roughly the same, you haven't bought or sold an entity, all right? So assuming that stuff is relatively constant, all right? What have my losses been doing? Have they been going down? It seems to me, okay, it probably has, okay? But I would take another step and say, and ask the question, why did the losses go down? Dumb luck? Or did we do something, okay, that impacted that? All right. So if it's dumb luck, a retro plan might not be the way to go, might not be the way to go at this point in time. If our reduction in losses are because one, I identified an exposure or an issue and I decided to treat it, and the way I treated it worked. Okay, that's probably a pretty good match. Okay. The um, efforts that I put into it, and this gets to Mildred's comment here. Okay. If I'm going to invest money in loss control and loss reduction, okay, well, that's a good thing, okay? But under a retro plan, who's going to benefit from that investment? Okay, and yes, from a social perspective, the reduction of injured workers, yeah, okay, a good cultural thing to do. I understand that. But you know, if I'm looking at a plan that enables me to clean up uh, on this, yeah, the more money I invest in safety and loss reduction, okay, is going to come right back to me in spades, right? So um, let's take let's take another break here, and then we're going to move into self-insurance. So let's add another 10 minutes here. So at 27 past, okay. So see you in 10. Okay, welcome back, everybody. Um, Same old question. Can you see and hear me? Oh yeah, thanks, Marlene. Appreciate that. Great. Um, okay, so let's talk a little bit about self-insurance plans. Okay. Now, if you recall, earlier on, we were talking about guaranteed cost, dividend plans, slides, small deductible, large deductible, retro plans, and that ever so common phrase, having skin in the game. All right. The more skin you have, you meaning the insured, has in the game, the more willing the insurer is to provide some flexibility, having input in the decision-making process on claims, so that type of stuff. So we had situations where we have a large fleet, probably, I don't know, 1,000 vehicles, roughly. Okay? And we self-insure physical damage to our vehicles, and we also have a substantial deductible under auto liability. And so when a circumstance happens, okay, we are all over it. We know what happened, why, what the concerns are, and you know we you know we want to understand the claim. And so there was one claim in particular, it was a truck claim. Our truck was taking a left, okay, and at any rate, some of the specifics were: we're taking a left, crossing over a double yellow line into a plant or a commercial user, and we're delivering oil, okay, or fuel. And so what happens on this is, everybody can picture a tractor trailer, a big tanker truck, all right? And they're, a good size, all right? So we're crossing the yellow line, taking a left, all right? 2-lane highway. So we take the left, we're going into the entrance of the factory, and the cab goes by, the front of the trailer goes by, and now the rear wheels on the trailer are crossing the center line. We're about, I don't know, halfway into the oncoming lane with the rear wheels, and a car, okay, crashes into our rear wheel um, um, of the trailer. So 80% of the truck had already gone by, okay? And so we've got pretty good details on all of this. And then we get our loss run in, okay? We're waiting for, actually, no, we're waiting for the adjuster assignment. And the adjuster says, no, we paid this claim. Okay, I said, well, wait a minute, what are you, what are you talking about? So the adjuster says, yeah, okay, your truck crossed the yellow line, you're at fault, we paid the claim. Okay, and they paid, I don't know, 60 grand or something like that. So we looked at him and said, well, wait a minute, time out. Okay, one, and then we gave him all of the specifics, okay, none of which they knew. Okay, and I said, you know, by the way, did you also know that the driver didn't have a driver's license? It wasn't that they didn't have it with them, they were an unlicensed driver. And so, again, as I've said, I can't make this stuff up. The adjuster says, well, that doesn't make any difference because your truck still crossed the double yellow line. I said, yes, we're making a delivery, and that's the only way you could get to the facility, okay, is to cross the road, okay, and in a turn. And I said, just for the sake of argument, okay, what if the reason why they didn't have a driver's license was because they couldn't pass the eyesight test? Long pause. So I said, when you did your investigation, do they wear glasses? Well, I don't know. Have they ever had or attempted to get a driver's license? I don't know that. Okay. So how many people do you have listed as the car, in the car? Well, 4. Well, the police report says 2. So was it 2 or was it 4? All right. And so I think after my 20th question, the adjusters, went, all right. So we fought and really forced the insurance carrier to pay the claim on their own, not subjected to our deductible, which they really didn't like, but they realized they didn't have a leg to stand on. And those are the things that are so important in managing your claims, which then gets us, and I think some of you are probably saying, what does that have to do with self-insurance? Well, a lot, because when you have that level of detail, knowledge, and expertise, you are probably a good candidate for self-insurance because you think about all of this stuff. You ask the right questions, and sometimes, less experienced adjusters do that. And I would like to think, although I have my suspicions, but I would like to think that adjusters apply the same level of integrity on the investigation and adjustment and payment of a claim, regardless of the deductible size. So I would like to think every adjuster asks the right questions and does the same due diligence, okay, whether it's a guaranteed cost, okay, or a $500,000 deductible. Okay, so I don't know that, but I would like to think that. So self-insurance is going to give the insured, okay, now I say insured, but they're not really insured, they're self-insured, but it gives the insured the ability to really control and manage their claims. Now, if you are managing an insurer or a TPA, and you're managing it closely, you're probably in decent shape, okay? However, that doesn't allow you, it doesn't get you off the hook, okay, with arguing coverage. And, I jokingly say, but it's entirely accurate, okay? Under our self-insured, and we have self-insured programs in certain areas, okay? When it comes to a self-insured loss, I will tell you, okay, I have never argued with myself as to whether a claim is covered or not. I make the decision and it's done. I don't litigate. I don't sue myself. Okay. And in that sense, okay, it's really kind of refreshing. Okay. I remember the very first check, okay, I had issued under our self-insurance program, okay, and I had it done within an hour, okay, of receiving the claim, understanding it, interviewing our person that was part of the claim, okay, and said, you know what, okay, our fault, okay, sorry, we owe the money, right, and I authorized the check. And I remember sitting there going, wow. And if anybody ever remembers, there was a commercial on TV, and it was Staples, I think, and there was a red button, okay, and the motto of the commercial was somebody would slap the button and go, that was easy, right? Remember that commercial? And yeah, that was the exact moment, okay, when I had our first check issued, thinking to myself, wow, that was easy. Okay, I loved it. I was actually looking for more claims because it was so easy. All right, it was awesome. All right, so a self-insurance program can be wonderful. All right, and it's really the next graduation step from a retro plan or a very large deductible. Okay, so that being the case, okay, what are our goals here? What do we want to learn? We want to describe the features of a self-insurance plan and determine their appropriate application within an organization, right? So, for example, okay, does it make sense for me to be self-insured everywhere? No. Okay. Remember early on, one of the things that we talked about when we were talking about insurance was a mechanism to pay claims. That's part of it. But for us, we know we're going to pay the claims anyways, but we use insurance companies largely for compliance issues. we end up doing business with ABC company, and ABC company says, I want a certificate of insurance. We got to be able to issue that. Okay. And sometimes, okay, with insurance, self-insurance, that can be a hurdle. And I'll share with you, and I wish I were kidding, right? We were applying for self-insurance in Ohio for workers' comp, monopolistic state. And so we were declined, okay? And so there's an appeal process for that. And so, like me, okay, I appealed. And for that, you get called out for a hearing to testify, okay? So I show up at the Workers' Compensation Bureau for Ohio. And, keep in mind, this is an air flight, okay, a night in a hotel or 2 nights, okay, fair amount of preparation. All right, so an effort. Right? And so I walk in to the receptionist and I say, I'm here to meet Mr. So-and-so, okay? And so the receptionist, again, this is the Workers' Compensation Bureau, looks at me and says, I don't know if he's here today. So I'm thinking, okay. And the next thing you know, we're standing there looking at each other. And so I then said, well, could you call his office and see if he's there? She goes, yes. Picks up the phone, calls, and says, yes, he's in. Okay, how do I get there? Okay. Well, I'll call and see if he'll send out his receptionist. And I'm like, oh my God, this is workers' comp. So at any rate, only to find out, okay, that this was a day of hearings, and there was probably 5 or 6 of people like me, okay, that were in for the appeal process. So we eventually, won the right to get our self-insurance permit, right? But this is the stuff that you face with some of these, processes. Okay, it's like unbelievable. We also had to pass the financial wherewithal muster. Okay, and that's again appropriate. So one of the things I asked for was 5 years of financial statements. Hey, no problem. Here's an annual report, or actually 5 of them for the past 5 years. Okay. Guy sends me back an email. This is after a month of having them and 2 months of my following up. Okay, because that nobody answers the phone. So you leave voicemails, hey, where are we on this? And so after a total of 3 months, I get an email saying, Dave, you're declined. Okay, your financial information is incomplete for year, whatever year it was, 2021. Okay, you're missing a balance sheet. For 2022, you're missing an income statement. For 2023, statement of retained earnings is missing. Okay, so I'm like, oh my, now this is the guy that determines the acceptance of somebody applying for a workers' compensation self-insured permit, okay? And his job is to review the financial wherewithal. He's a financial analyst, okay? So I'm thinking, oh my God. So I call him up, arrange for a telephone conversation. And I said, well, okay, let's look at the first year. Okay, you tell me I'm missing my a balance sheet. Yep. Okay, well, let's open up the annual report that you got. Yep, got that. Let's look at the table of contents. Yep, got that. Okay, balance sheet, page 8. Okay, let's go to page 8. Okay, and guess what? There's the balance sheet. Okay, so I said, okay, is that okay? Does that, we all set there? Yep. Okay, we're all set. Now, year 2, you're saying I'm missing a statement of retained earnings. Let's go to the table of contents. Table of contents, page 22, statement of retained earnings. Let's go to page 22. And there's the statement of retained earnings. Okay. We all set there? Yep. So we go through this for all of these, and I'm thinking, oh my God, here's a guy that can't even get through the table of contents. And again, these are the people that are making these decisions. And so, a self-insurance program, okay, can be wonderful. Okay. But you got to be smart enough to know, can you manage that? Just because you think you can doesn't mean you can. So for self-insurance plans, okay, Self-funding approaches, commonly known as self-insurance plans, give an organization the highest level of loss sensitivity. Well, why? Well, because I'm self-insuring. Every nickel, dime, quarter, and $100,000 claim, okay, comes across my desk looking for a check. All right. So I feel the pain, each and every one. I've had, you know, heroin addicts. I've had attempted murders. I have had, family disputes. Okay. You name it. I have seen it through a workers' compensation program. Can't even begin to tell you all of that. All right. So two main types, qualified and non-qualified, right? And so my department, we almost never get involved with non-qualified. Those are HR people, okay? Now, on the qualified plans, that's statutory coverage, workers' comp, auto liability, and, depending on the arrangement, general liability. Each of these plans can be either fully self-funded or paired with excess insurance coverage, both per occurrence and aggregate, to protect against catastrophic losses. Sure. So, it's funny, if you've ever gotten a certificate of insurance, who is it? I think it is Home Depot. Okay. I'm pretty sure it's Home Depot. And if not, I think it's Lowe's. It's one or the other. Anyways, when you ask them for a certificate of insurance, okay, the workers' comp section, they actually do this really well. The person issuing that really understands. So under the statutory or other box, okay, they check other. Okay. And then for the policy number, they put in, let's see. Okay, so Sarah Lee, I'll get back to you on the Home Depot. But what happens is they issue the permit number for the policy number. It is other, okay? And it's other because they're self-insured up to, I want to say 25 million, but then they have excess insurance over the 25 million to satisfy the statutory obligation for an unlimited benefit limit. Okay, so for workers' comp, you can be an assigned risk for 4 employees. Okay, and your medical and indemnity cap, okay, is not capped. Okay, it can be, up to, a $500 million claim, and the insurance carrier is on the hook because statutory means unlimited benefits. Okay, so the issue on Home Depot, I would tend to disagree with that Home Depot doesn't carry workers' comp. Workers' comp is required by statute. Okay, I'm not aware of any states that it's not mandatory. Okay, and so what we may be talking about there is an exceptionally high self-insurance point, but at some point, whether it's 25 million or otherwise, and I think it's 25 million, because some of us states that we're in, we have a $25 million self-insured exposure, but then we buy excess insurance on top of that to satisfy from 25 million to the unknown forever unlimited dollar amount above that. Okay, and that's how we satisfy the state requirements. All right, so at any rate, those are qualified. Qualified for our purposes, we can also use the word statutory requirement. Each of these plans can carry either fully self-insured or paired with excess. I gave you the example with the home supply company. Self-insurance plans may cover a single exposure, like workers' comp, or have multiple lines under one plan, such as workers' comp and GL, EL, or AL. Okay, these plans offer the utmost flexibility. Recognize, though, okay, if you are self-insured, you have to get a permit, okay, in the states in which you are operating as a qualified self-insurer. So if you're in, as an example, 30 states, okay, most companies, in fact, are not self-insured in all 30 states because you are looking at essentially a full-time department. okay, doing all of the paperwork to get your permits renewed every single year, okay, in each of those 30 states. So they usually identify maybe the top 5 states with the highest exposure, and self-insure in those states, and then pony up with an insurer for a large deductible to handle all the compliance filings in those other states. That's a typical approach. Self-insurance involves a single organization shouldering the risk and paying for its own losses without pooling exposures or resources with others. Yeah, absolutely. It's a standalone deal. You're on the hook. Fundamentals of self-insurance. In practical terms, self-insurance means that an organization's management, okay, not me, an organization's management has chosen to internally finance a layer of primary coverage or certain risks, allowing them a degree of control over the claims process. Okay. Now, if I'm a qualified self-insurer and I am in fact handling my own claims internally, do I have to comply with the Fair Claims Reporting Act and an adjustment process? What do you think? Yeah. Okay. Marlena. Yeah. Yep. John, you got it. Absolutely. Okay. Um, that's a big deal. Okay. Now, here's the other side of that. If I am a self-insured, am I entitled to either protection or prosecutorial um, restitution under insurance fraud? Or in other words, if a claimant attempts to defraud me as a self-insurer on a claim, okay, can I lodge a complaint and or seek to have them arrested, okay, by the appropriate authorities, even though I'm not an insurance company? So, and I think Marlena, I think you're answering a no to that one. The answer is yes. Okay. Now, it'll vary somewhat from state to state, but clearly the norm is the statute for insurance fraud is if any individual or organization, okay, does or attempts to defraud any insurer or self-insurer, okay, they include it by definition, okay, they are subject to the rules that pertain to insurance fraud. Okay, so that's a good thing on that. There are a lot, there are a lot of times. Okay, we have actually paid somebody, okay, to demonstrate the execution of fraud. Okay, so kind of interesting. You know, um, So FYI on that. And sometimes that can be helpful. Insurance companies, it really irritates me a bit when insurance companies don't pursue fraud. Okay. Sometimes either because it's my money and they really don't care, or on a guaranteed cost, they're like, you know, insurance fraud is normal. Okay. Why bother? No, okay. I can't tell you how irritated that makes me. We had a workers' comp, no, excuse me. We had an auto liability claim. Our guy rear-ended somebody else's car, I don't know, 10 miles an hour. So a minor detail. All right. Anyways, the injured person was a hairstylist. Okay? And part of her claim, okay, was she could no longer work because as a hairstylist, it required her to, obviously cut people's hair, but her arms were up in the air, okay? And because of the injury, she could no longer lift her arms up in the air to reach people's heads for, to cut hair. Okay. So I'm looking at this going, oh, this is is nonsense. Okay. And Tisha, I see your question here. I'll jump back to that in a second. Okay. So what happens here is, I'm like, no way. So I went around the office. The claimant actually in the occurrence was not too far from our office. So I went around the office, okay, and I was looking for people to volunteer, to get a free haircut, okay? But they had to go to this lady. They had to make reservations, and I needed 8 hours of haircuts, okay? And that's when I realized, you know, that's when I realized, okay, for guys, okay, for us to get our hair cut, okay, it's kind of, what's the price? Who cares? How soon? I'm done. I'm out. Okay. Women, okay, because I wanted somebody to, that would get hair coloring, be a fair amount of arm activity. Okay. Okay. Women, little different. Okay. To get a woman to go to, an unknown person to get a free haircut. And of course, in my mind, free, I'm all ears. Let's talk about it. How do we execute that? But with women, no way, no how. I'm going to go to Mary. I've been going to her for 30 years. Okay. I would never let anybody else touch my hair. Okay. And I was shocked at that. I had no idea that was a big deal. Okay. So at any rate, I get this lady with 15 haircuts, okay, in one day, all with guys from the office, because they were looking at this going, hey, free haircut. Dave's paying for it. Done. All right. So we had to run videotape, for, 7.5 hours of one haircut after another. Okay. And so, yeah, won that one. Okay. But would an insurance company do that? Yeah, no way, no how. Okay, wouldn't do it. So, got another question here. Can a self-insured company pursue subrogation claims? Absolutely. Okay, because all right, remember, well, and assuming there's no waiver of subrogation clause, okay, anywhere in the process. Okay, so assuming that, absolutely, because if I'm a self-insurer, I'm entitled to the same rights and protections of an insurance company. Okay, so I'm stepping into the shoes of the insured. Okay, so absolutely. Okay. Oh, interesting. Okay, going to read this to you from Jim. I was hit by a car riding my bike a few weeks ago, and while I'm mostly okay and obviously not milking the system, I often wonder if State Farm are stalking me. Okay, well, if it's State Farm, and no knock against State Farm, okay, probably not. Okay, all right. And it depends on the overall value of the claim. If your bodily injury is, 4 grand, maybe not. Okay. If it's 40 grand, maybe. Okay. But yeah, from my perspective, I would assume so. But I will also share with you, okay, one of the places I was working, I uncovered massive fraud from the insurance broker, okay, in excess of over $1.5 million per year. And when I uncovered it, okay, the broker was less less than happy, okay, and I would get phone calls at 3 a.m. in the morning, okay, with this guy just swearing at me, saying all kinds of not very nice things. Okay. Now, I've been around the block. There is not much that upsets me. Okay. And by and large, I would say I don't have any feelings. Right. So that's that. But I will share with you, okay, every evening, every afternoon, when I would go out to the car to leave, I looked under the car, I popped the hood, looked in the engine compartment, because I thoroughly expected, okay, an explosive device. Okay, I kid you not. When I actually started the car, I did so with the door open. Okay, once the car started, ran, then I would close the door. Okay, so yeah. All right. So now Christine's got interesting. This is going back to the hairstylist. To be fair, you don't know how much pain she was in that night. Speaking to as someone, let's see, let's see. Speaking as someone with a pretty severe shoulder injury that is much worse at night, and who used to do it to hair, or used to do hair. Yep, no problem, Christine. Not a problem. Okay. However, okay, we did a fair amount of homework, okay, throughout the process, okay, and that was just one of the several things that we exercised on this. So, yeah, do I make a snap decision? No, I make a snap judgment, okay, and then I do my snap judgment. Simply been doing this for a few years, and I always like to see, was I right or not? Okay, then I jump in and do my homework. Okay, because at the end I can also be penalized, okay, for unjustifiably denying a claim. Okay, I get that. It works both ways. All right. So in my mind, only an idiot, okay, would, make a snap decision without having facts in hand and then look to stick with that decision. So that's kind of a big deal. But yes, no, absolutely right. Latent injury, latent pain, completely understand. Okay. And so I was more sharing that story as a component, not the end all to be all in the exclusive test to determine the level of injury, if any at all. Okay. So let's see, what was he doing? Okay. Katie, what do you mean? What was who doing? Okay. What did you mean by that? So if you could follow back on that, and while you do that, oh, to defraud me. Okay. Yeah. Okay. The broker. So the broker was actually charging a fee. Okay. And it was a fee agreement, but also I found out by doing my digging, because numbers just didn't seem to tie out for what I would consider to be usual and customary rates. But he was also collecting a loaded commission. He would go back to the underwriter and say, I want you to adjust the rates, excuse me, to reflect a 20% commission on the comp, the auto, and the GL. So they were getting a 20% commission and charging us a 10% fee on the coverage that was placed. And in this particular state, okay, charging a fee and a commission was illegal. Okay, so at any rate, oh well, so that stuff happens, right? So at any rate, oops, sorry. When losses are predictable in both frequency and severity, self-insurance is typically the most cost-effective way to manage these risks. Okay, absolutely. Now, remember, losses need to be predictable, not mandatory, but it's best if they are. All right, but also I got to be smart enough, okay, to manage this. Okay, it really, if you don't have the wherewithal, okay, don't bother. Okay, this will be an expensive way to go. Okay, we as brokers, another comment, okay, as brokers, to disclose the commission and fees. Yeah, absolutely. And then I can pick and choose. Do I want to pay a fee? Do I want to pay a commission? Do I want to pay a little bit of both? Whatever it is, okay, it's got to be disclosed. Okay, and this guy was trying to hide it. Okay, and at the end of the day, with 30%, if you will, charge for placing, some of these things, which, for comp as an example, was a 6% commission. Okay, and this guy was getting 25, or in some cases 30. It was crazy. So at any rate, that's that. Qualified self-insurance. Qualified self-insurance is a mechanism for self-funding exposures, subject to state regulation. That's key. Right? With state oversight of a self-insured organization, the victims of industrial accidents and illnesses and of motor vehicle accidents will receive the same benefits as they would get from a traditional insurance carrier. Right now, if you're talking workers' compensation, the benefits 66 2/3 of the average weekly wage. Sure, if I'm self-insured, I get to do the same thing, right? Pay the same dollar amount. The difference is perhaps, okay, and I say perhaps, the level of investigation and homework, okay, that the two organizations undertake may be and likely different. All right, I'm one of those people. I get into the rabbit hole. All right, that's where I get my kicks. Okay, I want to understand how and why it happens, and frankly, part of that not only to protect ourselves from fraud, but also, if we messed up, okay, I want to know exactly why did we mess up, how did it happen, and I'm immediately going back saying, this is what we need to change, right? Big deal, all right? And you want to get it right, okay? And a good investigation benefits several parties, okay? So qualified self-insurance plan regulators typically require the following. Plan must have a written actuarial opinion. Okay. Self-insured organizations must complete and file audited financial reports. Most regulatory bodies require each self-insured organization to file a surety bond as collateral and do not permit other less expensive forms. Now, for us, we've been waived. We actually don't post collateral in a few states, right? And why? Don't know. Never thought to pick up the phone and ask, how come you're not charging me collateral? Okay. Unless they request it, no sense to argue something that would put me in a less advantageous place. Pros and cons. I think you definitely want to know pros and cons, okay, of retro plans and self-insurance plans. I think, all right, this is intended to be, okay, pros and cons of self-insurance plans. Okay, so that might be a little typo there. The organization retains strong control over claims, losses are predictable, shield from the impact of adverse loss, okay, and experiences of other entities. Yeah, so to a certain extent, my rates, okay, under a traditional insurance plan are going to be influenced by industry results. If I'm self-insured and I run a good shop, well, you know, I'm largely going to be shielded from, the an industry loss, okay, that I end up having to contribute to. Reinsurance for property resulting from the California wildfires. You know, we have had a factory in Florida. It was in the middle of the desert, right? And so, am I worried about a fire? No. Right? Do I end up having, impact from reinsurance rates hit my other program, my other property program, none of which is in California? You better believe it. Okay. We saw our property rates double, and in some cases over the period of, time, the dark ages, saw them triple. Okay. So disadvantages, if losses aren't controlled, look out. Okay. Third parties wanting to have a certificate of insurance. Yeah, so we're going to pony up with a fronting company, another, a Liberty Mutual, a Zurich, an AIG or something, and we pay them a fee to issue a certificate. That way the other party, they don't know. Okay. And nor do they. It's a drawback for privately held organizations because of the disclosure of financial information. Okay. So as I provided financial information to the gentleman in Ohio, does that become public information since they are a governmental entity? I had to get them to execute a non-disclosure and confidentiality agreement with regards to our financials. Okay? Not something that I normally have to do, especially if I'm a public company, okay? Because again, all that information is out there. Let's talk about a knowledge check. Big company is one of the largest corporations in the US and worldwide. Okay, first thing that comes to my mind is their data, losses, forecasts, development, payment triangles. They're probably credible enough to stand on their own. So, okay, fine, let's keep going. They have decided to self-insure all exposures starting next year. Well, depending upon when we're asking this question, that may or may not be enough time. Okay? Management identifies its biggest risks as property, GL, AL, workers' comp, D&O and EPL, and fiduciary. 6 months into the self-insurance program, big company receives a violation notice from several state insurance departments stating that they lack workers' compensation and auto liability coverage. The notice does not mention the other 3 coverages. Okay, why? Okay, now come on, this is a layup for you guys. Okay, we're in the home stretch. Okay, let's go out with a bang. All right, so why would states not care about property insurance, okay, and D&O? Others not required. Yep. Workers' comp and AL are regulated. Okay. Yep. Absolutely spot on. All right. So thank you. Appreciate that. Okay. Explain what big company will have to provide to satisfy the insurance regulators and other governmental agencies in those states, right? So what are they going to have to do? So this is a little bit of a incomplete question, right? So they're either going to have to provide a copy of their permit, all right? And I'm assuming that legally, big company did it the right way, and they did get a permit, but the compliance people may not realize that big company is a qualified self-insurer. So sometimes we've had to provide a copy of the permit, all right? Or if I'm on a fronting arrangement, okay, so maybe I've ponied up with AIG, all right, and said, hey, I'm a qualified self-insurer, but AIG, I want you to issue certificates with the AIG name on it. And for that, I'm going to pay you 100 grand a year. Okay, so maybe AIG didn't send the notice of coverage to that particular state. So not catastrophic, okay, a couple of hoops, you need to jump through, but not a big deal. So good question, Kendall. Do they permit only where they have offices? Okay, sort of, okay. And so to be a little more specific on that, if you're going to be a self-insurer, you need to be a self-insurer in the state in which you designate. So for example, I may be based in New York. I have a national workers' comp program, with insurance coverage with your traditional Zurich maybe. But then aside from that, maybe I choose to be self-insured in, Montana, Kansas, Texas, Louisiana, and Alabama. Right? Now, each of those states, I'm going to have to qualify independently of being a self-insurer. Each of those states are going to issue me a permit, and each of those states are going to require me to renew that permit every year. All right. So it depends upon the states in which I choose to be self-insured. Okay. Let's see. They need to be. So Charles says they need to file for approval based on their balance sheets to self-fund. It's more than that. Okay. So balance sheets are definitely a component. Cash flow, number of employees, the sophistication and the ability of the self-insurer to administer and pay claims and to adjudicate. So it's kind of a little bit of a dance, dog and pony show that you need to get approved for. So yeah, all right. So it's a little bit more than the balance sheet. Okay. Yeah. Okay. Oh, here's a good one, Marlena. How does that work if you are designated? Oh, wait a minute, just jumped here. Wait a second. How does that work if you are designated in Minnesota, okay, but work in North Dakota State Fund? Permits in both? Okay. No. Okay. So if you are self-insured in a state, okay, you need to, just like an insurance policy, endorse it to be, or your permit or your responsibility to include, as an example, all states endorsement. So if you have somebody that travels back and forth in 2 different states, okay, that endorsement, okay, on your permit process would say, I have an employee in Minnesota. They travel back and forth to North Dakota as part of their servicing activities, okay, and their job employment. If they are injured in North Dakota, okay, the Minnesota benefits will apply. Okay, and so that's how you would do that. Let's see. Okay, so Mildred, need to get a certificate of authority to operate as a self-insured entity. Yeah, so certificate of authority or permit, okay, those are synonymous. All right, so summary. To develop an effective risk management plan, organizations must first assess their goals, risk appetite, and risk-taking capacity. So yeah, all right. So it's not so much risk appetite. They're looking at the number. Okay. If it's going to be, saving them some cash, then they're going to do a deeper dive. Okay. But if the savings aren't there, nobody cares. They're not going to do it. So if the savings justify the deeper dive, then it's going to be, can we do it? Do we have the wherewithal? Okay, but it's all, at least my experience has been, it's all driven by the number. Simple risk financing options include guaranteed cost or fixed cost plans, dividend plans, and deductible plans, all of which offer basic coverage where the insurance carrier manages all services within the policy limits. While these simple risk financing options typically feature minimal internal financing, okay, such as maintenance deductibles to manage minor losses, they also introduce concerns about extra policy losses that could create significant risk. More advanced options, such as retro plans, um, insurance plans, and large deductible plans, provide added flexibility, loss sensitivity, and cash flow. And again, of those, okay, cash flow is the operating word. I mean, if it's no cash advantage, the decision to go self-insured or large deductible plans, okay, is probably going to be a no, right? It's risk versus reward, right? If there's no reward or an insignificant reward, why assume the risk? Okay. A thorough understanding of these risk financing strategies empowers organizations to make informed decisions that align with their unique risk profiles and financial objectives. The risk profiles, that's what you're going to ask when you're doing your survey. And financial objectives, they may or may not share with you, okay? But you can ask some leading questions, all right, that might steer them down that path, but probably not. Okay, but you can flush that out when you offer different financial variations of your proposal. When we talked about the retro agreement, because there are substantial upswings and downswings, you have the loss pick in the example that we had was 200,000. So yeah, I would also take it upon myself to include, well, what happens if my loss pick is 100,000, and what happens if my loss pick, which ultimately becomes the accurate, the actual losses, is 300 or 400,000. Okay? Then somebody can look at this and say, the savings may not justify the ultimate, maximum risk, the financial risk, right? So I think that gets, yeah, okay, that gets us to the end of the program, okay? And so if anybody has any questions, give a shout. You're an awesome group. Appreciate the questions. Greatly appreciate your patience while we were fumbling through the, the thing not working, okay? But at any rate, I'm going to blame Rich on that. It was obviously his fault, okay? So if you have questions, okay, outside of this particular program, and you're just interested, like, hey, what do you think about this? What's maybe a good way to approach this? And you want to reach out to me directly, feel free, no big deal, okay? You can reach me on LinkedIn, okay, that's easy enough, or my email address, I don't know if it's in part of the program, it's Dave Hershey at, so D Hershey, Hershey, at Axel Johnson, AxelJohnson.com. So again, no big deal. And, we want to make everybody smarter, put everybody in a good position, write some business and, go for it. All right. So again, thanks everybody. Greatly appreciate it. All right. And I shall talk to you later, hopefully. All right.
Thank you, Dave.
Always a pleasure, Rich.
Folks, I hear David, Dave, of course, Dave's one of our regulars. I hear him all the time, and every time there's always something new that I didn't think about before that I pick up. So again, thank you personally, and thank you on behalf of everyone. So
no problem. And Rich, you did make note on a couple of those what appear to be typos.
Yeah, okay. I already took care of that.
Great, awesome.
Yeah.
All right, great. All right, I'm going to sign off, everybody. Thanks so much. Greatly appreciate it, and appreciate it, Rich. Okay. Yep. I was kidding when I was blaming the IT thing on you.
Yeah, I know.
All right, great. Thanks, everybody.
Okay.
Bye.
Bye. Okay, let's see. I got a few buttons to click, and I think we're Ready. Okay, so into the program or into the session reminder evaluations, you should have 3 of them. And remember, we're going to talk about proctors and all that stuff, but remember, you have to start thinking about that if you're going to take the exam. If you're not planning on taking the exam, you are free to go. We will resume tomorrow morning at 8 o'clock Central Time. If you are hanging around for the exam briefing, we are ready to start right now. As soon as I can get this rascal to click. There we go. The purpose of doing this is to try to make, we want you to be successful. We'd like you to pass the exam, but more importantly, we do want you to learn stuff that you can actually use. Whether you pass the exam or whether you take the exam. The purpose of going through this extra little exercise is to much as our exam window is this Monday, starting on the 16th at 12:01. Well, I got a typo on that. Let's see, I'm getting a slow network connection. I'm going to turn off my webcam. I grabbed the wrong thing. I'm sorry. I got so many different files for this stuff. Nope. This is the one I wanted. Okay, that's the correct one. Sorry. Okay. There is this is the slide I was talking about. There's your exam window. This Monday, the 16th through Thursday, starts at 12:01 a.m. If for some reason you want to do something that early in the morning, fine. But it's important to think ahead for Thursday night. That the program shuts down at 11:59, so don't plan on waiting until like 11 o'clock Thursday to maximize your study time, because you're going to be short. So do keep that in mind. This is what you need to know about the exam. It's 200 points. It requires 70% or 140 points. It's a pass-fail. You never know your exact grade, and you never see the exam again. Not a big deal. The exam answer format is always short answer. There's no true false, no multiple guess, multiple choice kind of things. It's just explain, define, answer like what happens if this, that kind of stuff. Requires as you were talking to a client in the real world. So you don't talk to clients saying true, false and stuff like that. Probably 20 questions, 19 maybe, or 21, but probably right around 20. Most questions have multiple parts, 2 to 5 multiple parts, maybe 6, depending on the nature of the question. But the important thing is the questions will come at you in agenda order. So the first couple of questions will deal with learning objective 1, section 1, learning objective 1, 2, 3, 4, in that order. And then the next couple of questions will go to 2, 2, 2, and then 3 and 4 and 5. So it's the same way it's presented to you. If this is your first CRM exam and you're taking this for either the first time or to earn the CIC designation as your option, it is a 2.5-hour exam instead of a 2-hour exam. The nature of it is a little bit more, a lot of explanation of how things are rather than just a short answer like, is this covered or not? Bang. Okay, it's like kind of like that. Not all the questions require very wordy answers though, but it's a little bit different. Obviously, we don't take kindly to getting inappropriate help on the exam, because that diminishes the value of the designation. So therefore, you do need a proctor. We'll talk more about proctors in a moment. I write the exam as we're going, and I like to focus entirely on learning objectives. So everything that you'll see in here is is directly tied to one of the stated learning objectives. There are 22 in this course. And on a finance course, I generally ask questions on about 16 or 17 of them, almost 3/4 of them. So it is, you really do need to all the material. Don't sit there and say, well, I don't understand anything in the live action, so I'm going to really make sure I'm good on the first 4 sessions. That's probably not a good strategy. Make sure you know all of them. But I will tell you this, there are no calculations of any type. So there's no calculation on how we would compute stacking, stack. No idea why this happened. Okay, I don't know what the last thing you heard was. Was it about this number of objectives covered, no calculations? Okay, no calculations. There's no stacking calculation, no retro calculation. So, okay, so again, 16 or 17 of the 22 learning objectives will be covered. So it is a thorough exam. Everything in this course is important. There's nothing that's trivial. You've got, let's see, you might, if you get some study time in tonight, that'd be really good. Did I say there would be no calculations? Yes, I did say there were no calculations. Back to studying, study a little bit, no questions either. Doesn't have a formula to, you don't have to calculate because that's too many steps. I have time to do that. Study a little bit every day. So you got a little bit tonight if you can stand it, a little bit tonight, and you got Friday, Saturday, and Sunday, and maybe Monday or Tuesday, depending on when you're taking the exam. I encourage you to take an exam earlier in the week than later. We had a case here last year where somebody waited until Thursday, and then lo and behold, there was a bad audio restored. We're having the tail end of a tornado watch here, so weather is a little wonky, so that might be interfering with connections. I think I've closed everything that I can close. Yeah, so. Okay, the proctor. It is a disinterested proctor. We recommend using Monitor EDU. It is a virtual proctoring option. You need a fully charged device, smartphone or a tablet, and they will observe you. There is an extra fee for that of $18, but the counter of this is you can take it at your convenience in a nice, comfortable place like your home or your office, something like that. You may need to have a Google Meet app. It depends on what your equipment is set up. And yes, you'll get points per section, questions per section tomorrow. Yeah. Disinterested third-party proctor. You could go to a brick and mortar, libraries, universities, learning centers, your licensee insurance association like a Big I or a PIA may be able to accommodate you. If you work for a large company that has a dedicated HR department, that is perfectly all right. We trust them, or training department. We trust them to, make sure everything is proper. It reflects on them if you do something improper. So that works too. But Monitor EDU is what most people do because it's sort of on demand. The disinterested third party is exactly what it means. Somebody who has no They don't have a dog in the fight, so they don't care if you pass or not. They're just there. That means these kind of people are not, these are parties of interest for you, particularly friends, family members, peers, supervisors, that kind of stuff. So they have to be a distant person who really doesn't, has no, like I said, no dog in the fight. You want to make sure you have the proctor set up, because there's a whole bunch of protocols. The proctor has to sign in with a pen we give them. They have to confirm your ID, make sure you're getting no outside assistance, no course materials. I mentioned you don't need a calculator or a cell phone, so don't worry about that. And they will watch you for the entire duration of the exam. To select that, you need to have that set in place, and you do that. We'll talk about the process for that in a second, before the exam window opens. So that means Sunday night at midnight, that goes away. You have the advantage of being able to contact somebody at exam help at riskeducation.org or online classroom at riskeducation.org during business hours, Central Time, like 8:30 to 4:30, but that's only tomorrow and Friday, because they're not there working on the weekends. So if you wait until the weekend and you have problems, then you're kind of up a creek. I have no idea how this stuff works. I'm just telling you what I'm told to say. I stay out of that. I'm a risk management expert, not a how to take an exam expert. But you do get to it by going to your profile, log in, get to your course history, and you'll find a button that says proctor associated with your course that you're taking. Okay, that looks like this. So you'll go to sign in, my courses, course history, and there you can see the box that says request proctor. That's how you do it. Click, and then you'll see a screen that looks like this. And if you're doing monitor EDU, you use the little slider right here, and that's all done. If you're having something else, then you got to fill all the other stuff out and submit it for approval. So that's why most people pick monitor EDU. You just want to, if you're saying, oh, gee, I want to take the exam at 8 o'clock, you ought to get the proctor set up at least by 7:30, something like that, because it takes that long to make sure that they connect and all that. So, just plan on maybe an extra hour before you're ready to really take the exam. You don't launch the exam until they're there. You'll get this orange button down here. When you pay for the monitor EDU, you'll get a receipt number, and that allows you to connect to proctor. And then off you go. You can take it whenever you want. If you want to do it 3 a.m. in the morning, they'll find somebody to proctor you. If you have any questions about that, do not contact me, please, because I don't know. I can't help you with that. I'd like to, but I can't. Exam help at riskeducation.org is the right people to talk to. Exam help at riskeducation.org. And of course, this stuff is on the recording, so you can always refer back to it. When it's exam day, sign in, get to your page, go to your home page, go to your learning portal, go to your course tile on the learning portal, hit the launch button, and you'll find exam button down at the bottom. Oops, there we go. All your course materials, learning button, there you go. That's what it looks like. That's what that screen looks like. And then this is the screen that you get to. Final exam, you click that after you read the exam instructions and the acknowledgement and all that, and boom, you're off and running. It is a digital exam, so all makes sense. Make sure a quiet place, no distractions, no materials close to you or your cell phone. You don't need a blank scratch paper. You don't need a calculator. Obviously, you can't run around and have fun, but if you need to go potty, you can certainly do that. Don't take anything with you. Don't bring anything back. But do make sure that you go to the next question, because the responses are automatically saved when you move to the next question. That way, if there's a glitch, you don't lose something that you may have worked on already. The proctor will be able to see your screen. It has a digital alarm or digital clock on it to tell you how much time is left. Helps the proctor enforce the time limit. The exam auto submits, so it's kind of, the proctor really doesn't enforce it, because when it hits 2.5 hours, it's click and it's done. If you finish before 2.5 hours, and most people do, you can submit your exam if you're comfortable, and but I would encourage you to make sure you look for all questions, make sure you didn't leave any blanks, but don't second and third guess yourself. Generally, your first impression is probably the right one. Again, if you got any technical difficulties connecting, examhelp@riskeducation.org during business hours on weekdays. That'll be Monday, Tuesday, Wednesday, Thursday. But during business hours. Exam tips: make sure you read the exam question carefully and think about what I'm asking before you launch into telling me everything you know about something. Make sure you answer the question that I asked, not the one that you have a really good answer for. Do answer all question parts. Be as concise as you can. You don't get extra points for throwing lots of stuff at me. Believe me, I can tell if you know the stuff, and most of the answers don't require lengthy, wordy, it's just cut to the chase. If you don't know the answer, make sure you always scroll down till you get that button that kicks you to the next page. If you don't know the answer, skip it, because it is agenda order, and maybe something in a later learning objective will cue you and you'll go, oh, I remember that now. So you do want to make sure that you do come back and answer everything. Scoring wise, you don't lose points for wrong answers, you gain points for correct answers. So leaving a blank is 0 points. Putting down just a wrong answer doesn't cost you any points. Unless you put down, if I want 3 things and you put down 2 that are right, you get credit for the 2. You don't lose more points for the 3rd one, you just don't gain the points. Almost every, well, not almost every little bit of knowledge on my exams is worth 2 points. So if I ask you for 3 things on a list, that's going to be a 6-point question. If I ask you only 1 thing, it's 2 points. There's nothing more important or less important. Everything is worth 2 points. Again, no calculator necessary. 4 to 6 weeks, and about 2 weeks after you're done, I get a little note says, hey, the exams are ready to be graded. I do grade my own exams. I've written this course material, probably written one version of it at some time, and been involved in every course revision. I wrote the Risk Management Essentials book. You can see that, you could see over my shoulder earlier. Yeah, not to be bragging, but I know this stuff. And if you put down an answer that I think, ooh, that's a good answer, I wish I would have put that down as the answer key. I wasn't thinking about it. I was looking at the learning objective. You're going to get credit for correct answers, even though we didn't have it in the learning guide. So asking a really stupid question that's badly worded or something, I'll be able to detect that when I see your answers and go, okay, I figure out to make this. You'll get an email when I'm done, and then you go to your profile and you find out how you did. We hope you get it all right. I mean, that'd be perfect. It'd be wonderful. It happened twice where I had 100% pass. So, but it doesn't happen often that way. But we're going to be positive. However, if you do stumble, strongly encourage you to request an exam review. You fire yet another email off to exam. This